Hello, everybody, and welcome to our webinar presented by the Centre for Economic Policy Research and the International Monetary Fund on the World Economic Outlook from June 2020. Today, we're broadcasting to you on both Zoom and Facebook Live, so you're all welcome. My name is Tim Phillips. I'm going to be moderating today, and you see the subtitle of our webinar, A Crisis Like No Other, An Uncertain Recovery. And we'll be investigating what the IMF's June World Economic Outlook had to say about both of these statements in the next 60 minutes. Well, who's going to help us do that? We have three people on the panel today. And first of all, I'd like to introduce Gian Maria Milesi-Ferretti, who's the Deputy Director in the Research Department of the IMF. Gian Maria, welcome.
Thank you. Glad to be with you.
Gian Maria, you've presented a few of these economic outlooks, and I mean, just the size of our audience today tells you that you can't have presented many that have had quite so much interest in what they say, can you?
Yes, I'm afraid that the seriousness of what's going on is something that is really attracting a lot of attention, and rightly so.
Yeah, now you're going to be presenting some of those findings from the outlook in a couple of minutes' time, and but we also have two other people to introduce first of all before we get going, and Silvia Ardagna from Goldman Sachs, the Managing Director in the Investment Strategy Group. Silvia, welcome.
Thank you very much, Tim. Good morning and good afternoon to everyone.
And you'll be looking at the impact of what's been happening in the global economy on advanced economies. Also, Harm Zebregs, who's a vice president, also from Goldman Sachs in the Investment Strategy Group. Harm, I believe you have a special interest in China and emerging markets. Welcome.
Hi, Tim. Yes, absolutely. And hi to everyone on the call.
Yes, and I also believe that you're an alumnus of the IMF as well. So it's like one big family today.
Looks like it, yes.
Okay, now it's not a webinar if you don't ask questions. You will see, you should be used to this by now, but you'll see down at the bottom of your screen, it says Q&A. You click on that, type in your question. If you click on that and you type in, and you see a question that either you think is particularly good or is the question you were going to ask, you can upvote it. It comes to the top of the list, and so we see it at the top of the list. And I'll be getting through as many of your questions as possible with our panelists today. We've left a good amount of time, so please do ask anything that's on your mind. Well, that's relevant to this, of course. So first of all, I'd like to hand over to Gian Maria, who has a presentation for us on the outlook. Gian Maria, floor's yours.
Many thanks, Tim, for hosting. Many thanks to CEPR for organizing this event. And I'm really happy to have two old friends discussing this. We've crossed paths so many times in the past. Let me then try to move down the slides and say a bit why, in what sense this is a crisis like no other. I'll start with the speed and size of decline in activity. I will just give you a 20-second picture of how we saw it in-house. In January, we presented a WEO update forecast in Davos, and we basically at the end of January, we were forecasting global growth to be above 3% in 2020. By the time we were all sent home from the IMF at the beginning of March, our growth rate had declined by at least a couple of percentage points. And by April, early April, when we finalized the April WEO, we were forecasting a contraction of 3% for the global economy. So we're talking about a 6 percentage points plus swing in global forecasts in the space of a very few weeks. And unfortunately, the downward revisions have continued, and the forecast that I'm going to present is, in terms of annual growth rates, even more negative than the one we had in April. Let me tell you, though, a couple of things about how different this recession is. I mean, there has been a lot of attention to the size and to saying, well, this is the worst since the Great Depression in terms of output declines. But what is different this time in terms of the composition of the output decline? A typical recession is a sharp contraction in investment, consumption of durables, and both are very trade intensive. So you see a collapse in global trade. But generally, private consumption, particularly of non-durables, is more resilient. You have some smoothing going on. This downturn is very different in many ways. You have a collapse in consumption of contact intensive services, as you well know. And indeed, if you look at PMIs, you see a sharper decline for services than you have for manufacturing. You still have a very big hit to global trade, of course, in part also because this crisis by its nature is closing borders. But still, in comparison with a typical recession, in comparison with the GFC, taking into account the size of the impact on GDP, this is more of a services crisis, and the decline in trade, while dramatic, has not been as extreme as you could have guessed just on the basis of the decline in GDP. What is also extraordinary has been the nature, and I'm sorry for the type, although it's actually the mature response is actually correct, in the extraordinary nature of the policy response, both in terms of magnitude and speed, and that has been absolutely instrumental in avoiding worse outcomes. And finally, extreme uncertainty. We are, as a profession, just not very good at forecasting GDP growth, and in this particular instance, the uncertainty that comes with extreme economic events is compounded by uncertainty, which is even more difficult for us to quantify, which relates to the path of the pandemic. And that will play a super important role in shaping up how economic activity how and when economic activity will recover. And I will come back to that in the next few slides. I have here just a couple of illustrative slides that give you a snapshot of some of the aspects that have kept us thinking over the past few months. One is the path of a number of indicators for China, which was, of course, the first country hit with a massive hit in the first quarter of the year, but has since seen a pretty sharp recovery in activity, even though, of course, the most affected services sectors remain quite a bit below where they would have been. And then you have some data on US spending that just gives you a sense of how extreme the hit to the contact intensive sectors is. And finally, some charts on global trade that also point out the very sharp contraction in cross-border commerce that has come over the past few months. Say clearly, we just got data for April. April is the trough of global economic activities, probably the trough for global trade as well. On the inflation front, there was a lot of discussion on the relative importance of demand and supply shocks. One should highlight enormous measurement difficulties here, considering the changes in the nature of goods. If you want, a restaurant meal used to be a restaurant meal where you had basically very low probability of getting sick, while a restaurant meal without restrictions on masks, on density, is now a very different product. So comparing prices is not quite the right thing to do. Having said that, it's pretty clear that with the sharp decline in spending and the reallocation towards some categories, we have seen a decline in overall inflation, also because of the sharp decline in oil prices. And that has come despite the fact that some goods, particularly food prices, have tended to increase in price. But clearly, downward pressures of inflation, many concerns of a de-anchoring of inflation expectations and risk of deflation if the decline in activity persists for a longer period of time. And extreme, unprecedented monetary and fiscal support. And I think this is absolutely essential to understand what is going on. And I think it is absolutely essential in putting a floor under economic activity. I think if you just consider the situation in financial markets in mid-March, over a period of less than 2 weeks, you had the nominal effective exchange rate of the dollar appreciate by 8%. I think it's an unprecedented speed over such a short period of time. It was clearly a panic, spreads widening, equity valuations plummeting. And clearly the very aggressive response of central banks has put a floor under these market declines, have helped a resumption in confidence. We are now, if anything, worried more of a disconnect between market optimism and, still very uncertain economic prospects, but undoubtedly from the point of view of countries needing to finance, large support to their economies, from the point of view of emerging economies in a dire situation from the point of view of the pandemic, this situation is, of course, much better than the situation we were in just a few months ago. In order to present the forecast, there is enormous uncertainty. It's very important to specify what we are assuming here. And I have in this slide just a list of what our basic assumptions are. And what I want to highlight is, in particular, that with respect to what we were forecasting in April, we clearly are seeing a larger hit to economic activity in the first half of 2020. This is particularly the case, although not exclusively the case, in advanced economies that were, let's say, the first really in terms of the progression of the pandemic after China. And we are realizing that, again, the decline, even in Q1, but especially in Q2, is even more severe than we were forecasting back then. So it is a little bit of a rear view mirror revision, if you want. So we are talking about the past 6 months more than we're talking about the forward-looking part. Although there is, of course, a change of view on how the forward-looking part is going to evolve. And in the absence of a medical solution yet, we clearly see persistent social distancing and sort of lingering effects from gradually lifted lockdowns in the second half of 2020. These effects are stronger relative to our April forecast for emerging economies, which in many cases, think of Latin America now, have been affected very severely by the pandemic, but somewhat later than countries in Europe, for instance, or even the US. And given the size of the shock and the uncertainty about its persistence, we see greater scarring than envisaged in the 2020 wheel. On the positive side, we have better financial conditions, more policy support, and from the point of view of some emerging economies, stronger, somewhat stronger commodity prices, again, a sign that markets have turned more optimistic, that activity has restarted, and that has moderated at least a bit the severity of the shock, particularly to oil exporters. I will just show you a couple of tables with numbers with growth rates for 2020, 21, and revisions. But I'll go quickly over them because you can peruse the numbers in our WEO update. What I want to highlight in particular is across advanced economies, how dramatic the decline in activity is. It is a little bit more modest in advanced Asia that has been more successful in containing the pandemic. That's clearly the case for Korea and Japan, but very severe in the US, the Euro area, in the UK, in Canada. And let me clarify one thing with regard to forecasts. Many forecasters are raising their forecast for the US economy on the basis of the more recent data on employment and activity. I think uncertainty is still enormous, but one thing to keep in mind is we are not projecting adding to our forecast an additional fiscal stimulus beyond the one that has already been legislated. And clearly, so if that were to materialize, other things equal, you would see sort of upside risk to our US forecast. On the other hand, of course, we see that the path of the pandemic is far from being controlled in the US, and that, of course, is a concern in the other direction. For emerging and developing economies, the revision, with the exception of China, is actually sharper than it is for advanced economies. These countries were affected much more severely. You see the size of the revision and forecast, for instance, for India and Brazil is dramatically worse. And the same is the case for Mexico. We have a very, very sharp contraction. It's really unprecedented for this country group. And, you know, again, one of the key issues is that the pandemic is not yet under control, and so uncertainty on how long certain restrictions on activity and endogenous social distancing by people is going to persist is really a big question mark. So it's a very difficult moment for countries, many countries in the emerging world. Again, it's a very heterogeneous picture across countries and across regions, and that is something that we need to keep in mind. This is a chart that summarizes our forecasts on an annual basis over 2 years. So it is growth between 2019 and 2021, and how that forecast has evolved over the past 3 years, starting from January to April to June. And you see that fundamentally our current forecast has, for both advanced economies and emerging economies excluding China, GDP in 2021 will be below its level in 2019. So if you take the forecast in January as trend growth, you see how massive the hit of this shock has been. And in a sense, how China is the one with a considerably smaller set of revisions. Again, you know, China had a very severe, epidemic in Wuhan, but was able to contain it more effectively in the rest of the country. And while lockdowns were severe, the disruptions were much less strong than the ones we've seen in most advanced economies and in many emerging economies at the moment. Because the crisis is moving at really high frequency, we also have a chart, and it is this one, that looks at the quarterly profile of growth. There is, you know, not every country in the world publishes quarterly data. So the coverage of this chart is the entirety of advanced economies, because everybody has quarterly data. But for emerging and developing economies, it is the lion's share of GDP, but it doesn't include everybody. Having said that, you sort of see the path. You see for China an earlier hit to activity, a later hit for advanced economies and emerging economies, and you see a recovery which is gradual. I mean, people love putting letters or symbols on the type of recovery, so they call it, I think, something like a check mark recovery or a swoosh, but it's fundamentally a recovery that is taking a time for a GDP to get back literally to its pre-crisis level, let alone its pre-crisis trend. And again, I think China is an exception in this regard. We also present, this is a point forecast. There is a lot of uncertainty on how things are going to pan out. We have two alternative scenarios. They are just illustrative. And one of them has a second wave of infections materializing and hitting fundamentally 2021 growth. By assumption, we could have it hit a bit of 2020. We would see fundamentally the same image. And we have, at the same time, a faster than expected recovery. This could be associated with, the signs, positive signs we have seen on PMIs and restart of activity becoming stronger, and potentially, the fundamental issue would be a vaccine solution appearing more quickly towards the end of the year, which would restore a lot of confidence on the future of sectors that are currently under a lot of stress. I want to come back briefly to this issue of uncertainty. And again, I have a list here of sources of uncertainty that go beyond the pure economics. And clearly, the likelihood of a second wave, the effectiveness of tools to deal with its eventual recurrence, the control of the pandemic in countries that still see rising infections, the timing of vaccine development, timing of diffusion, all these things are absolutely crucial over an horizon of certainly 12 to 24 months, but could be even beyond, because they will affect how the economy will shape up. Will we need a massive reallocation of resources away from contact-intensive sectors if no medical solution is found? Or on the opposite, will we see these sectors coming back a bit like the travel sector after September 11? And then, of course, the need for structural transformation will be there, but will be less dramatic. The reallocation of employment need not be as extreme. And then we have sources of uncertainty on the economic front, of course, that intersect with those on the pandemic front. And I have a list here, but of course, you know, the scarring is the first thing that comes to mind when one thinks of the depth of the recession, but there is also a productivity hit from safety measures. But you could have potentially productivity gains from a speed of digitalization and other aspect of reorganization of work. But it is obviously a bit early to tell which direction these things will play out. I will close with, a slide, and we have much more detail in the report on risks and policies. On risks, let me just add, besides the uncertainty about the evolution of the pandemic, the fact that clearly financial conditions now are consistent with things improving over time, and in a sense with the evolution of the pandemic globally being brought under control. It is clear that if that were not to happen, or other factors could spook market sentiment, the situation could become much more complicated for a set of emerging and developing economies, potentially some advanced ones too, that are struggling with high vulnerabilities, high levels of debt, and the like. And of course, we worry about escalating geopolitical tensions, potential for social unrest. You have massive distributional issues already existing and potentially amplified by a crisis that is hitting employment very heavily in an employment of labor that is relatively less skilled, and hence the burden is really hitting disproportionately weaker segments of the population. In advanced economies have been kept afloat by massive government intervention, but those cannot last forever. And in emerging and developing economies, the scope for that support is much more limited. So big issues to think about. And of course, I think on the policies, it is essential to stress how fundamental it is for the response to be targeted, but very, very aggressive. The issue is really keeping the connective tissue of the economy alive. Multipliers in the short run may be very low just because people cannot spend much during lockdowns, but they are massive when you talk about restarting the economy. If you have a substantial fraction of your firms going under, if you sever relations between workers and firms, restarting the economy is going to be a much more protracted, much more difficult process than if the governments intervene early and aggressively. At the same time, it is absolutely essential to target those interventions and to be flexible in responding to the evolution of the pandemic. I mentioned before this uncertainty about the future of sectors that are contact intensive. So how much will it be keeping firms alive while a solution is found, and how much will be facilitating the reallocation of resources across sectors? The strategies are not the same, and we need to be ready to move from one set of policies and principles to another. Last thing, but super important, is international support for vulnerable countries. That goes from the need for medicine and eventually for vaccines to reach countries that need it, for medical supplies to reach the countries that need it, and for financial support, debt relief, and not just that, for countries that are struggling with, again, weak health systems and difficult financial situations. Could go on for a long time. I've probably taken too much already. Thank you very much, and I very much look forward to the discussion. Thanks.
Thanks very much, Gian Maria. Before we let you go on this one, could we give you just one question before we throw over to Silvia, seeing as we've got a very good one coming from Alfredo Hernandez, who says, one thing we didn't talk about very much was inflation. We didn't talk about it in great detail. Do you see a risk of a global deflationary spiral from lack of demand, or inflationary spiral from the actions, the various actions of governments around the world? Is there an opinion on that?
It's a very good question, a difficult one to answer. I would say clearly in the short run, I worry about deflationary pressures. Now, again, I think we should not give for granted the credibility that central banks and independence that central banks have. We know that when those things are lost, anchors can de-anchor, but I don't think we are in that situation. I think the pressures are, again, at the moment to the downside. Economic activity risks to be weak for quite a while. Output gaps could be large for quite a while, especially if these workers that need to be reallocated from sectors that are shrinking to future growth sectors, that process is going to take time. So at the moment, I would say I would see concerns for most countries, certainly for advanced economies, more on the side of downward pressures, weak demand rather than overheating, at least certainly on the price front.
Well, that's something that Silvia might have an opinion on, but I better introduce her now. So Silvia and Harm, welcome. Thank you for your patience. And I believe that you have some slides to present in a reaction to this economic outlook from where you see it.
Yes, thank you. Okay. Thank you very much, Tim, again, and the CEPR for inviting us to introduce. And thanks, Gian Maria, for this great presentation, and obviously for the extensive analysis in the video that offers all of us in the private sector a very good guidance for our own forecast. I think as a start, I just want to tell you that we share with the IMF thinking a very similar approach, and our considerations are very similar to the ones that Gian Maria has made, both in terms of the depth of the decline, but also the prospect of the recovery and the risks and challenges that the world face in these circumstances. Now, I will start from the last point that Gian Maria had on his first slide, which has to do with the tremendous uncertainty that there is around growth forecasts, both for 2020 and for the following years. So what I wanted to show you here is a little bit how private sector analysts are seeing the world in terms of the growth outlook. The first chart on the left in these slides just plot what is the average of the growth forecast for 2020 in the top panel and 2021 in the bottom panel. And as you can see, likewise, the IMF, come end of February, there has been a sharp decline in the growth forecast for 2020. This sharp decline has continued more or less continuously up until the beginning of May. Since then, it has been pretty stable. And actually, as Gian Maria had just noticed it, if anything, private sector forecasters have revised their outlook for some countries to the upside to account both for the more encouraging high frequency data that there have been. This is, for example, the case of the US with the most recent retail sales report and employment report, to consider the fact that financial conditions have eased again very fast. And to take into account for developed improvements into the lockdown severity measures that have been taken, particularly in advanced economies. So for developed market now, on average, forecasters expect a 6% hit to growth in 2020 and a 4% recovery thereafter. But beyond this mean, there is a huge, very wide, forecast ranges. And here you just see what are the distributions of forecasts for the US on chart 2 and for the euro area on chart 3. And, if you take, for example, the euro area, forecasts grow for minus 14% in 2020 to -6. Recoveries growth rate goes from, 1.5 to 12% in 2021. So this really tells you how, broad and how uncertain the world looks to us as well, for all the reasons and considerations that Gian Maria has basically pointed out just now. So in the next, I would say, couple of minutes that I have, I would like to, move behind and discuss a little bit what is, some of the deeper challenges that some advanced economies will face going forward, beyond what is, the point forecast for growth in these coming 2 years. And I will focus on, again, one particular aspect that Gian Maria discussed, which is the fact that the recovery is likely going to be uneven and partial. And what that means when you look at DM economies is that this uneven and partial recovery will basically lead to even more macro divergence, which particularly for the euro area is going to pose challenges in the years to come. Now, the first slide, the first chart shows you real GDP in major DM economies index at 100, not in 2019, but back in 2007, pre-global financial crisis. In this way, you can see a little bit how much of the divergence was already created by this first crisis, how much was closed during the following 12 years, and what this, sharp recession in 2020 will imply for the future. Now, obviously, as we all know, the US had recovered much faster from the global financial crisis than all the other countries. And GDP, we expect that GDP at the end of 2021, more or less, will be back at the level of 2019, which implies that compared to pre-global financial crisis, you have an increase in in real GDP by about 25%. But if you look at the euro area, things look much less encouraging. We were up by about a bit less than 10%, 9% in 2019. We expect that compared to pre-global financial crisis, real GDP will be higher by just an approximately 5%. And if you look within the euro area, the divergence is even, more striking. Obviously, we had Germany overperformance over the past, 15 years. Spain had done since 2015 the very high growth rate in Spain compared to the other euro area countries had basically led the country to regain in terms of real GDP versus the others. But moving forward, we see again a pretty sharp divergence opening up between the countries like Germany and Spain, and even more so Italy, which was already lagging behind and had real GDP barely at the pre-global financial crisis level before COVID, and now we see it remaining substantially below 2019 level by the end of 2021. So this will clearly, particularly for the euro area, in our view, pose challenges for the future, given the commonality of monetary policy. the different growth patterns, but also the different fiscal space that countries had before the pandemic crisis implied that countries could, use the fiscal lever and fiscal policy to a different extent. If we look at the amount of discretionary fiscal easing, it has been clearly very different what we have seen in terms of support to the economies happening, for example, in Germany or in Italy again. And if you look, in 2021, what we are seeing is that even in terms of fiscal fundamentals, that this chart shows you just in terms of deficit to GDP ratios and public debt, we are going to see much bigger divergence that we had before. So again, this will be, challenging, particularly in the euro area, because of, whatever, fiscal framework there will be post this crisis, but also because, again, what we learn is that, still countries that are more vulnerable, as Gian Maria was mentioning, are likely to have already been much more constrained in this crisis. And so they are likely to be even more constrained in the future in their ability to support their economies when a shock hit. With these thoughts, I would just, stop here and give the floor to my colleague Harm to discuss a few issues on emerging markets.
Thank you, Silvia. Hello to everyone watching this webcast, and thank you to the CEPR for having us and allowing us to share our views on the WEO. I think Gian Maria gave an excellent presentation. I mean, the WEO, as Silvia mentioned, is an important tool for us. I mean, if you think about an anchor, when we think about the outlook for the global economy, for developed markets, emerging markets, the WEO clearly serves as such an anchor. And especially in this very uncertain time, it's obviously very helpful to have such an anchor. So on this issue of uncertainty, clearly for emerging markets, there are a couple of issues that add to that uncertainty and that make the situation for emerging markets often more severe than it is for developed markets, where the situation is already very dire. Of course, many emerging markets depend on commodity exports, commodity prices, although they have stabilized, as Gian Maria mentioned. Clearly, they will be lower than where they otherwise would have been had the global economy been expanding at a positive rate. External demand, of course, is also very important for many emerging markets. The countries in East Asia, for example, although they've been more successful in containing the virus, these are very open economies, and usually when they were hit with a negative shock, they would be able to export themselves out of that shock. This time around, that's going to be much more difficult when the entire world is in recession. Other important sources of revenue for emerging markets are tourism for countries such as Thailand, Indonesia, Turkey. Remittances, another important source of revenue for countries such as Mexico, for example. All these sources of income are being affected by this crisis and will have a negative impact on the outlook for emerging markets. And then, of course, many emerging markets have rather weak healthcare systems, so that makes it much harder to control the disease. In addition to that, many of these countries have large informal sectors, many people that live a subsistence lifestyle. And lockdown measures in a situation like that are obviously going to be much less effective. I mean, if you live on a subsistence income, basically your choice is being starving or exposing yourself to the outside world, continuing to make a living, but of course running the risk that you will catch the disease. So the outlook obviously is very difficult for emerging markets, as is highlighted in the WEO update. So beyond the near term, we also asked ourselves, well, how are emerging markets going to come out of this crisis? And so we looked at episodes where emerging markets suffered very large negative GDP shocks. And the chart here on the left is showing the situation around the global financial crisis. At that time, the average shock for emerging markets. So here we define the shock as the decline in GDP relative to the 5-year trend leading up to the shock. So the average shock was minus 7.6%. This time around, with the COVID crisis, the shock is much bigger. For example, China's decline in GDP relative to its 5-year trend through 2019 is minus 14%. For India, it's minus 11, minus 12 for Russia, minus 9 for South Africa. So these are bigger numbers than the average shock experienced by emerging market countries during the global financial crisis. But what we asked ourselves is, well, how do these shocks affect subsequent trend growth? So what happens to trend growth after you're hit with a very big negative GDP shock? And so what we observed is that the unconditional decline in trend growth is relatively modest. It's 50 basis points. So the average or the median emerging market country saw a slowdown in trend growth after the global financial crisis of half percentage point. But when we split the group into countries with high debt or debt below the median and debt above the median, then we get a starker picture. And what we see is that for countries with relatively low debt, the impact on trend growth is actually positive, plus 0.3%. I guess that's within the margin of error, so we could probably assume that the impact on trend growth is negligible here. But for countries that went into the global financial crisis with relatively high levels of debt, the slowdown in trend growth in the subsequent 5 years was more significant. And these countries experienced a slowdown of about 1.5%, 1.5 percentage points. The important thing to note here is that currently countries, emerging market countries, are going or went into this crisis with higher debt levels than they had back in 2008. China, obviously, is a country that has seen a very sharp increase in its debt to GDP ratio. It started its debt to GDP ratio in 2008, before the global financial crisis, was 139%. Last year, the end of 2019, it stood at almost 260%. So that's a 110% of GDP increase in the debt to GDP ratio. For Brazil, the increase is also significant. Back into 2008, total debt to GDP was 117% of GDP. Last year, it stood at 163% of GDP. South Africa went from 106 to 137. There are only very few exceptions. There's only very few countries that actually had a decline in their debt level. One of those countries is India. There, the debt to GDP ratio went from 129% in 2008 to 126% at the end of last year. But the point here is that with higher levels of debt, it's possible that the impact on trend growth following the current crisis is going to be more significant than what we saw after the global financial crisis. And of course, that's combined with a larger GDP shock. So the GDP shock has been larger, and countries enter this crisis with higher levels of debt on average. There's a lot of uncertainty, of course, as we talked about extensively already. I think there's one thing that we probably know for sure, and that's that debt levels will rise further. And how much debt levels will increase, of course, depends on many things. But again, when we look at growth shocks, so after the global financial crisis, so the average increase in debt to GDP was 27.3%. But when we split the group of emerging market countries into those with smaller growth shocks and those with bigger growth shocks, what we're seeing is that the debt levels in countries with the largest shocks saw the biggest increases in debt to GDP. So just to summarize this slide, we're having a bigger shock to GDP this time around. We're starting with higher debt levels. So the expectation is that trend growth will likely suffer from this, and debt levels will rise substantially. Now, if we can turn to the next slide, of course, the increase in debt is also determined by the fiscal space that's available. The chart here on the left shows the primary balance of a range of emerging market countries. The dark blue bars are the primary balances last year in 2019. Positive means there was a surplus. A negative bar means there was a deficit. The green bars show the expected primary balances in 2020. And as you can see, even though emerging markets have announced smaller fiscal packages, as Gian Maria showed in one of his slides, than developed markets, the increases are still pretty significant. And basically, without exception, we're seeing a widening in deficit or a disappearance of surplus in emerging markets. Obviously, these primary balances are not sustainable in the long run. And the light blue bars show what the primary balance would have to be in each country if that country wanted to stabilize public debt at the 2020 level. So factoring in that this year debt levels will increase, then what primary balance would a country need to run to stabilize debt at that level? And of course, that means that in all countries, there will have to be some fiscal consolidation at some point. And now, of course, the fiscal space is not just driven by the fiscal balance. A country like Russia, for example, where government debt stood at 14% at the end of 2019. Obviously, countries with low debt have room to let their debt to GDP ratios increase. What's a sustainable level of debt for emerging markets? I mean, it's difficult to say. Often it's thought to be around 40% of GDP. For developed markets, it's 60% of GDP. I mean, these numbers are guidelines that people use. What we've done here when we try to estimate the fiscal space for these countries is that, well, let's be generous. Let's assume that emerging markets can sustain debt of 60% of GDP. So if they did that, if they let debt increase to that level, and then would have a primary balance that would stabilize debt at 60%, how much room is there relative to where they are at the end of 2019? And of course, the chart on the right is not very exact. I mean, I wouldn't take this literally. It's really more to give you a sense of which countries have more fiscal space and which countries have less fiscal space. And again, as I mentioned, Russia starting from a surplus in the primary balance and a very low level of debt to GDP. Obviously, it has a lot of fiscal space compared to other emerging markets. At the other end, we're seeing Brazil, where government debt stands at 89.5%. It's a country that's already running a primary balance that's not sustainable. So the fiscal space there is negative. Now, of course, when a country has negative fiscal space, doesn't mean that it's still not able to go ahead and announce additional fiscal measures. But it's an indication that the room this country would have to do counter-cyclical fiscal policy is going to be much more limited. And that's reflected, I think, also in the fact that in many emerging markets, although fiscal packages have been announced, on balance, they have been smaller than in advanced economies. So just to summarize this, our view, our outlook for emerging markets for the near term, clearly we expect a sharp deceleration, a rebound next year, but beyond that, we're a little bit somber on the outlook. We're concerned about a slowdown in trend growth in emerging markets and rising debt levels that will further weigh on trend growth. And so that concludes my part of the presentation. Let me end here.
Thank you very much, both of you. And we've got about 15 minutes left. We've got a ton of questions coming in. So I'm going to put questions to you and I'm going to group some of them together. So first of all, I wanted to go back to Silvia. And there are some questions about the disconnect between financial markets and the real economy worldwide. Massimo, for example, has been voted up. Yes, what is the impact of that? Will the corporate market disconnect from sovereign yields, and will equity markets move back to pricing fundamentals? Silvia, do you have an opinion on that?
Look, Tim, I think what markets have been surprised to the upside is certainly the extent of monetary and fiscal policy. And so they have reacted to this announcement in a pretty, positive way. And that explained, a lot of like the increase in value in prices that we have seen since the bottom toward mid-March. Now, when you think about the fundamentals and the valuations, if you look, for example, at equity market valuations using several metrics that financial market analysts use, the valuations are not as excessive as one might think, and particularly, if you consider the fact that interest rates are very low and they are likely to remain very low for an extended period of time. So in our own thinking, we certainly advise investors that, while when we had a 20-30% drawdown, it seemed to us at that point with the policy support that maybe investors had become way too pessimistic, and so we were basically giving advice to move in the other direction. Now we warn investors that although again we don't think that valuations are so expensive, in fact you can compare, for example, valuation metrics for the S&P now relative to valuations at the peak before the tech bubble, and there is a huge gap between those. What we think is that clearly the situation can be more uncertain, right? There can be some setbacks, but if we look 2 years, ahead or 3 years ahead, what we also point out to the positive side is that we are likely to go through a so-called period of economic expansion, because again, as we said, right, the fallout has been pretty significant. The recovery will be slow, but it will still be a recovery with a very easy monetary and fiscal policy environment. And I think that this is what, in a sense, supports, right, the price, the constellations of prices that we are seeing in markets.
Okay. Now, Gian Maria and Harm, I'm going to ask you both about trade, because we have several questions about that and the slowdown in trade, how that's going to affect the recovery. And of course, we are in before we had this crisis, we were in a period where we were in the middle of a trade war and there were serious structural problems at the WTO. So what is the impact of that going to be on the world's economic impact? Gian Maria, you go first.
So we are obviously very concerned by trade tensions. We were very vocal about this prior to the COVID-19 emergency. We still are, of course. There's another set of issues to deal with at the moment, but these lingering tensions are a problem. They risk expanding their scope beyond just the US-China disputes. We very much hope that countries will come together address the grievances in a way that is satisfactory to the parties involved, because the need for multilateral cooperation is rising, if anything. This is clearly a global shock. It knows no borders. This will already be a difficult recovery given the size of the hit. The last thing we want is to add global fragmentation and barriers and any consequence of increased geopolitical tensions to the mix, because that would worsen the outlook further.
Harm, what do you think from the point of view of emerging markets?
So as I mentioned, emerging markets, many of them are very open economies. Many emerging markets have been able to grow at very high rates just because they were able to export into a global economy, a healthy global economy that welcomed emerging markets. So if you reverse that, then of course you're making it more difficult for emerging markets to come out of this crisis. So anything that makes it harder to trade internationally will slow down the recovery in those countries, especially the ones, as I mentioned, that are very open, like countries such as Korea, Malaysia, Indonesia, Thailand, countries in East Asia, but also Mexico, of course, which is a big exporter to the United States. So anything that will make it harder for countries to export themselves out of this crisis, of course, is going to be a negative.
Gian Maria, Isabel's asking whether the policies that are putting in place at the moment give us a risk of increasing inequality and therefore social unrest with the consequences of that.
I think a lot of the policies are actually going in the direction of trying to address some of the potential inequality consequences. Think of the increased unemployment insurance payments in the United States. Think of the impact of the Kurzarbeit, the support to workers on furlough. You're trying to cushion the impact of the shock on those most severely affected. The notion that the easing by central banks is something that is bad because it's raising asset prices, I think it's, in this particular instance, really misguided. I think the last thing you want is a financial market panic. Last thing you want is runs. The people that suffer most under these circumstances are people at the lower end of the income distribution, because they're the first one that get fired. They are the workers, more with sort of a more marginal attachment to the labor market. So I think, clearly the fisc, the tax system, the expenditure system, they have to address concerns about income distribution, absolutely. But I think support to aggregate economic activity that has come from the actions of central banks, from enhanced lending facilities and the like, are just good policy at this juncture.
Silvia, there's a question here from Luca, who's talking about how governments in Europe particularly are supporting workers at the moment. Is this good policy, or might it slow down reallocation in the labour market in the longer term, which would delay a recovery?
I mean, I share what Gian Maria said. I think at this stage, trying to prevent this misallocation of resources, in the sense that creating, a very high unemployment rates that then lead to long-term unemployment and hysteresis, that would be what will, retard the recovery. So the idea of having short, work subsidy schemes is that government are trying to maintain workers attached to firms just for this period of time in which we have to apply these, lockdown measures and prevent that companies go bankrupt, or prevent that workers get fired and then, stay unemployed for a longer period of time. So eventually, and I think that maybe the bright spot that we also have to keep in our mind is that there has been and continues to be a tremendous amount of research and on trying to find treatments and vaccines. So eventually, this will hopefully, bear fruits. And if this happens, and in the meantime we have avoided useless, bankruptcies or a useless displacement of workers, this will help the recovery rather than than make it worse. So at this juncture, I would say that, again, in terms of the policy interventions, I think government also learned, in my view, from the global financial crisis, both in the monetary sphere and in the fiscal sphere. The responses come much sooner, has been much deeper. And the fact that has happened much sooner has also prevented that, this was going from a pandemic crisis to something that was going to have more an effect on also the financial sector, which, as Gian Maria said, would basically add an additional layer of complications.
Now, panel, we are going over a few minutes, but so I warned you this would happen. There are several questions, just so we can get through them before the end if we go over like 5 minutes or so. And there's so many questions, it's worth it. Harm, can I put one to you from Goranga Das, who's talking about the weakness of the development model pre-crisis has been very much exposed during the crisis. And he's asking, how important is it for the recovery and for development in developing emerging economies is building trust in institutions and trust between government and citizens? How important is that going to be?
Yeah, I think that's very important. I mean, especially in a crisis like this, for consumers, for people to feel confident that they can go out again into the street, to shops, to be safe. They need to trust policymakers, need to be able to trust policymakers and healthcare officials that the disease is under control and that the disease is not being downplayed as just a flu. And if there is this trust and there is clear communication about the situation, that of course will make it easier to get back to normal than there is when there is still a lot of distrust. Clearly an important element, but in general, I think building stronger institutions in developing countries, in emerging markets, is very important, because with stronger institutions, it's also easier, I think, to manage a crisis like this.
Mm. Gian Maria, Fabrizio Coricelli is saying that you're forecasting a faster recovery from COVID-19 than from the 2008 financial crisis for high debt countries such as Italy. What are the more favorable factors this time, he says?
Well, I have to there is a bit of a nerdy aspect to this answer. And it is the following. Why we have a collapse of growth this year? Because the first and second, and especially the second quarter, are going to be absolutely awful because of the closures. Mechanically, the third and the fourth quarter are going to be better, even if we don't go back to the initial level. By the fourth quarter, we will have recovered some economic activity as reopening has happened. So even if we had zero growth during 2021, we would still see a very high annual growth rate, because we would be de facto comparing activity at the end of this year with activity during the average of this year, which is awful. So a lot of this, statistical pickup is due to the mechanical effect of reopening. There are, though, enormous uncertainties about the extent of the pickup within 2021, how strong can activity be? And that will depend crucially, I think, on the evolution of the pandemic. And of course, on whether countries have been successful with their stimulus in, raising confidence that, the economy will be more, stronger and more resilient in the future. But I think, obviously, the risks are there. Debt will be permanently higher, there is no question, and nobody wants to downplay the potential longer-term consequences that this crisis will have. But that is fundamentally why the pickup is so strong.
Okay, we're nearly at the end. I'll put one more quick-fire question for all three of you. How about that? Bots, he asked this a long time ago. He wants to know how much the permanent loss in output might be in the medium long run. What are we facing there? Silvia, you go first, Tom, you go second, and then Gian Maria, you can finish off.
Hard to say. On the end, you would say that I know that was not what maybe Bert is expecting. I mean, on the one hand, clearly you have negative hit from the fact that you have to think about reallocation of resources across sectors. You have this high debt that is likely to stay for longer. But, on the more positive, it might be, again, this accelerating some technological innovation, digitalizations, to the extent that this increases productivity is a plus. Will also depend, there is a lot of discussion on, potential investment, boosting investment, and that, we will have to see how much of that will materialize longer term. From now, I would say that obviously, the way we have built our forecast is to expecting that trend growth declines relative to what it was pre-crisis.
Mm-hmm. Harm, how about you?
Yes, so I think definitely there's going to be a permanent impact of this shock on potential GDP. So one is just the level effect. So you have companies going bankrupt that won't return. So that means that even if you maintain the same trend growth rate, you're going to be growing parallel to the pre-crisis path. So there's a gap there, so that's a permanent loss. But in addition to that, as Silvia mentioned, and as I showed in the slides, there is also a risk, of course, that after such a large shock, that productivity growth will be slower, at least for a while, and that will then, of course, further aggravate that negative shock to an economy's potential.
Gian Maria, you get to finish off. You started, so you can finish.
I would say a crucial variable will be what happens with the development of vaccine and therapies. Are we able, to the extent that we will be able to get back the sectors that have been most severely affected relatively quickly? The scarring would still be there, you would still have higher debt, but you'd have a bit less of a need for massive reallocation of resources across sectors. If the longer this lingers, the larger the overall effect to the level of output, both through higher debt and through the productivity costs of the measures that you need to deal with a more protracted social distancing and the like. In October, we will have, with the full World Economic Outlook, a medium-term forecasts, I'm sure with very, very wide error bands, but we will formally have a 5-year forecast, which we didn't put out in April, given the level of uncertainty.
Okay, thank you very much. We do have to close now because if this was a real live conference, we'd be saying, we're sorry we've gone into your coffee break, but we have. Thank you very much to the panel. Thank you very much for all of your questions. There was one question about, will the slides be available? Now, my advice for that is to go along to the IMF website, and it's all over the front page. There's World Economic Outlook at the moment with with loads of really good stuff. Now, for our friends from Goldman Sachs, can I just check with you, Silvia and Harm? Your slides, they're cleared for public consumption, are they? Yes, that nods.
Yes, they
yeah,
are.
That's all right. So my mouth might be writing checks that the CEPR's website can't cache, but we'll do what we can to make those available for you. Meanwhile, thank you very much for everyone who came along to this. Thank you very much to the panel. Considering that we've just had a webinar about literally more or less everything, then I think we did really well to pack it into the time that we did. Thank you so much for your answers. Thank you so much for your questions. Now it just falls to me to say goodbye from all of us on the panel here, from everyone at the CEPR, and what we always say at this time: come back soon and remain positive by staying negative.